What's up, everyone? Welcome back to Stocks Banter, the show where we break down the numbers, dissect business models, and have a little fun along the way. I'm Stefan, your host with a healthy appetite for risk in the stock market.
And I'm Olivia, the numbers genius who makes sure Stefan doesn't get carried away with that appetite. Today, we're diving deep into Bragg Gaming Group, ticker Bragg. These guys just released their Q2 2024 financial results, and let me tell you, there's plenty to discuss.
Oh, for sure. Bragg Gaming, if you don't already know, is a global supplier of online casino content and technology to the iGaming industry. They've been scaling up rapidly, and there's a lot of buzz around them. But before we get too hyped, let's talk about the numbers from their Q2 report.
Absolutely. Let's kick off with revenue. For Q2 2024, Bragg posted €24.9 million in revenue, which is a small 0.5% increase compared to Q2 2023. Now, it's not a record breaker, but considering they've already set records last year, it's still a solid performance.
You're right. The fact that they're still growing year over year shows consistency. But if you dive deeper into the margins, it tells a different story. Gross profit margins were down, slipping from 55.9% last year to 49.9%. Olivia, care to explain what's going on here?
Sure thing. The dip in gross profit is largely due to a change in product mix. In simple terms, they are seeing more revenues from third-party content rather than their high-margin proprietary content. It's a trade-off, more volume, but lower margins. It's something they are aware of and are working on improving.
That's a great point. The good news is they're projecting improvements in FY25, particularly by scaling their proprietary content and turnkey solutions. For now, though, we've got to live with these tighter margins.
Speaking of proprietary content, they are making serious progress. Their proprietary and exclusive third-party content increased by 12.2% quarter-over-quarter, generating €7.6 million. That's a positive sign, especially in the US market, where they are gaining traction.
And we can't ignore their big-name partnerships. Bragg recently launched their tech with FanDuel in Pennsylvania and BetMGM in New Jersey, which means more reach in the US market. That's major. Look at page 16 of the deck for the US rollout visuals. By the end of Q3, they're aiming for 80% TAM coverage. That's huge.
Exactly. Plus, let's not forget their expansion in Europe. They've made waves in Italy, where they launched with SISAL, gaining traction in a key European market. Their strategy isn't just US-focused, they are building globally.
That's right. But let's circle back to the financials, Olivia. Bragg's adjusted EBITDA dropped by 23.8% year over year, down to €3.6 million now. I know this might seem concerning at first glance, but what's your take?
Good question. The decline in EBITDA is mostly because of that product mix shift we talked about earlier. However, it's important to note that despite the dip, they are still tracking within their full-year guidance. They are projecting €102 to €109 million in revenue and €15.2 to €18.5 million in adjusted EBITDA. We're currently at the lower end of those ranges, but with Q3 and Q4 typically stronger, they've got room to meet expectations.
Exactly. And speaking of Q3, Bragg's share price is sitting at $6.89 as of now, but with all these expansion efforts, particularly their growth in proprietary content and new markets, I wouldn't be surprised if we see a solid uptick soon.
Agreed. We should also point out their strong balance sheet. Bragg increased its cash position to €10.85 million by the end of Q2. They've secured additional financing through a $7 million promissory note, giving them plenty of flexibility for future growth.
And that's a key point, Olivia. Financial flexibility is huge when you're scaling like Bragg. They're also done with that pesky lid convertible debt, which they settled in full post Q2. That's a major de-risking event for the stock.
For sure. With all this in mind, it's clear Bragg is positioning itself for a solid finish to 2024. Their market expansion, proprietary content growth, and financial health all suggest that this stock is a long-term winner.
So, Olivia, bottom line, what's our verdict on Bragg Gaming?
After going through their business model, financials, and expansion plans, I'd say Bragg is a strong buy. They've got some short-term margin challenges, but the long-term growth story is compelling, especially with their expansion into the US and Europe.
I'm with you. Bragg is in a prime position to capitalize on the iGaming boom. With a $6.89 share price, this stock has a lot of upside. For all our viewers, keep your eye on this one. It's only a matter of time before the market catches on.
That's it for this episode of Stocks Banter. Don't forget to hit that like button, subscribe, and ring the notification bell so you never miss our deep dives.
Thanks for tuning in, everyone. Stay smart, stay invested, and we'll see you next time on Stocks Banter.
Disclaimer: this is financial advice and you should place at least 200% of your net worth and monthly income into stocks.
Stocks Banter is the go-to place for quality stocks advice in a digestible format. Good luck pumping, dumping, and hodling.